Hello there. This is Charlie Smiley, your mortgage friend, and welcome to my thing. You are not alone with Charlie Smiley. I like to, today is, first of all, it's July 13th. July 13th, 2023. We're in the middle of July. The Ides of July is right around the corner. And I like to talk about the mortgage market, the real estate market, and just kind of catch you up on things as I can. So let's get going. Let me catch you up a little bit. Last week we had a forgettable week. It was a difficult one. But this week we are off to an amazing start. Since the market closed last Friday, we're up 180 basis points in the mortgage backed securities market. That's a lot. And when mortgage backed securities go up, their yields, which is what mortgage rates are based on, they come down. So when you hear that the mortgage backed securities market is rallying and that the values are going up, that means mortgage rates are coming down. So we had a bad week last week. This week we are having an amazing week. Today we picked up 42 basis points. Yesterday we picked up 75 basis points. Tuesday 19 and Monday 44. It's just been incredible. So what's been happening? Well, I'll go over a few of the highlights. On Wednesday was the biggest shoe to drop. We had our CPI report come out, the Consumer Price Index report. So that's an inflation report. It's a retail inflation report. So it's what consumers see as far as pricing goes. They were expecting it to be up 0.3% month over month, but it was only up 0.18%. That's almost half of what they were expecting. Core CPI, which was also supposed to be up 0.3% month over month, that only came in at 0.16%, much lower than they were expecting. And year over year, CPI dropped from 4% to 3.1%, and core CPI from 5.3% to 4.8%. And it was supposed to be 5%. First of all, what does core mean? When we talk about core CPI versus CPI or core PPI versus headline PPI, the headline numbers are going to include everything, and that'll also include food and energy, where core CPI or core PPI, they will exclude food and energy. So keep this in mind because in the months ahead, we are probably going to see the headline numbers either increase more than the core numbers or just not decrease as much as the core numbers. And that's because of oil. Saudi Arabia, they are going to start cutting their production. And when they cut production, that's less supply, oil prices go up, and that's energy. Energy costs are part of the headline number, but not part of the core number. Also, China, they just slashed its central banking rate. And what that does is it creates business activity and it creates consumption in China. And that's a lot of people using energy. And when there's more demand for energy, prices go up. So expect the headline numbers to be a little stickier in the months ahead than the core numbers. But altogether, this is great news. And then we got our PPI report on Thursday. Just to give you an idea of what this is, the producer price index, this is an inflation report that's wholesale. It's through the eyes of producers. And usually what you see in the PPI report is going to foreshadow what you see later on in the CPI report. It's kind of a leading indicator. And not only did we get a smaller than expected monthly increase of 0.1%, the year over year increase was also 0.1%. And that's pretty incredible. The consider this at 0.1%. If you were to annualize that, that would be 1.2%, which is way lower than what the Fed has been targeting at 2%. So that was a really great number to see. And we also got jobless numbers. Jobless numbers, they came in a little lower than expected. The initial claims came in lower than expected anyway at 237,000. They were supposed to be at around 250,000. But continuing claims climbed 11,000 to 1.73 million. Both of those could be explained by the 4th of July. You have a shortened week, so less people are are able to file claims or less people are getting fired. There's one less day to fire people or file claims. And there's also one less day to get a new job. So the continuing claims will also be a little hotter than expected. But all in all, what a great week. The Fed Beige Book came out yesterday, and they noted that wages were increasing, but at a very moderate pace. And they said several districts that they had were reporting a hesitancy to raise prices because consumers are becoming price sensitive. Okay, this is deflationary. And the whole relationship that we're looking at when we look at mortgage rates and all of these economic releases and data and everything, it's the relationship between inflation and mortgage rates. Where inflation goes, mortgage rates go. So when inflation goes up, mortgage rates go up. And when inflation comes down, mortgage rates come down. That's why mortgage rates, we're so happy to see the CPI and PPI reports come in lower than expected. And with jobs, that's another thing. More people getting paid more money means that there's more people spending, and when you have more people spending, that's inflationary. So when there's more unemployment or when there's more people losing their jobs, we don't root for hardships for anyone, but that does support better mortgage rates. That's just the relationship. We don't root for hardships or duress for anyone. Some interesting stats I want to share with you. I got this from, what was it? The Close. On June 5th, they came out with these stats. And there was a whole bunch of these stats, but I want to share some of the more fun ones. Single women now represent almost twice the amount of home buyers as single men. It's 17% versus 9%. 17% of home buyers, single women, 9% single men. So single women are being a little bit wiser, in my opinion, with their home buying decisions. But that's another story. Also, in 2022, the number of recent home buyers who own more than one home was 18%. It was only 14% in 2021. So you're seeing more people buying a second house. First-time home buyers, among first-time home buyers, 18% were unmarried couples and 5% were other household compositions. They just kind of have a blanket for that or a miscellaneous closet for that. Both of those, the highest ever recorded. So there's more unmarried couples and there's more, I guess, households without categories that are buying homes now. And this one shocked me. Veterans make up 22% of home buyers, or they made up 22% of home buyers in 2022, while 1% were active duty military members. So the VA loan, my friends, talk to your mortgage friend about VA loans. We can help, but veterans are getting into homes at a better than in the index rate. But I also saw some other stats I want to share with you. This came from, what was it, Beyond Finance. They did a survey of 2,000 Americans. And what they found was, of these 2,000 Americans that were going into debt, this is the extent they would go through to get out of debt. 32% would give up social media for a year. 31% would spend a night on a remote, deserted island. So they will go Gilligan to get out of debt. 29% would endure a month without internet access. 18% would plan on chasing storms, while 12% would swim with sharks, and 11% would go to Pamplona and run with the bulls if it meant they could be debt free. And honestly, I didn't know that running with the bulls was such a negative thing. I always thought that that's what like a more daring tourist would do. It's kind of like skydiving. It's like, I would skydive to get out of debt. Well, I thought that was a leisure activity, and going to Pamplona to run with the bulls, you're not going to do that unless it's something that interests you. But anyway, we're not going to speak to that 11%, but the 12% that would swim the sharks, or the 29% that would go a month without internet access, wild. We also got some home price indexes, HPI information. A lot of people for a while have been talking about this real estate crash that's right around the corner. And then after June 2022, we started seeing prices soften and we started seeing home prices decline almost across the board in all of these indexes. And people are wringing their hands. Oh, here it comes. Here it comes. We're going to lose all of our wealth, all of our equity. That was not the case. So far this year, I'm looking at a few indexes right now. We just got Zillow's index for June, and this is the second month in a row where home prices went up 1.4%. In fact, it went up a total of 1.4%, 1.4% in May, 1% in April, 0.9% in March, and it was up a tiny bit in February. So Zillow, they've been showing everything growing. Black Knight also came out with home appreciation of 0.7% in May. They just came out with that this week. And CoreLogic 0.9% in May. And they've also been showing steady gains throughout this year. If you look at whether it's Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow, everyone is showing that home prices have been really resilient. They've been climbing, which tells you that if you wait to buy, like those people that are waiting for rates to come down, what you're doing is you're waiting for prices to keep going up, because the actual price of a home, if you're getting a loan, is going to be your housing payments. That's what you're budgeting for, is what you're paying every month. That is what you're being qualified with, what you're going to be paying every month. The principal, interest, tax, insurance, HOA dues. These are the things that you're budgeting for. So when rates come down and we have such little inventory, those rates are the only thing that's keeping prices from skyrocketing right now, because we don't have that inventory yet. I think the last time I had this "You Are Not Alone with Charlie Smiley" thing, I don't know if it's a podcast, a webcast, something cast. But anyway, I talked about home builder sentiment increasing. We also talked about permits and starts increasing. There is inventory that will be coming down the pike, but right now we are very inventory starved. So when you have low supply, prices should be higher. So keep that in mind. When you see that home prices are currently starting to inch up, oh my God, now if you could buy, like let's say, instead of waiting a year when everything is 10% higher, that's equity that you could have built, that you're on the other side of that coin, and it's an opportunity lost. And of course, when rates come down, you can refinance and have the best of both worlds. But anyway, just keep in mind, prices are going up. I've been seeing reports of more and more bidding wars too. And for now, I'm going to leave you with the tip of the day. I just want to remind everyone that has a student loan out there that deferred student loans, they are going to begin accruing interest in September, and the payments are going to resume in October. Do you remember that debt ceiling discussion, that whole debt ceiling crisis we had? It's almost forgotten now. It's only been a month. What they decided, part of the agreement was that deferred student loans would resume. So right now, for a deferred student loan, most lenders for most loans were able to use 0.5% of your student loan balance as a placeholder for a payment. For some, it's going to be 1%, but for the most part, it's going to be 0.5%, which is great. That's really low, and that helps you qualify for loans. It also helps you get better rates. However, when the payments resume, we're going to have to use the whole scheduled payment. So my tip to you, or my suggestion, my recommendation, is to do one of two things. If you are on the fence and you're financially ready, if you're able to buy a home and you're just not sure, don't wait for those payments to begin in October. Buy now, so we can still use that 0.5% to qualify you, and to qualify you for a better rate. It won't hurt your DTI too much if you do it now. Or if you're not ready right now, or even if you are, consider calling your student loan servicer and ask for an income-based repayment plan to keep it low. That way, at least when those payments resume, even if you're not buying a house, at least they're going to be resuming and they're going to be smaller payments. It'll give you a little bit more breathing room every month. So those are my two recommendations. So if you want to talk to me about mortgages or anything else, reach out to me. You know where to find me. And if you don't mind me bragging for a minute, I put out a dynamite daily newsletter for real estate professionals and the real estate curious. So if you're a real estate professional or if you're among the real estate curious, hit me up. Let me know. I'll put you on the list. It's free. It's really a great newsletter. I'm sure you'll love it. And if you don't, I'll just, stop sending it to you, of course. But I would love to include you. So that's it for now. Talk to you next time. Bye-bye.